Good evening, everyone, and welcome to the Journey to Multifamily Millions monthly webinar. I'm your host, founder, and CEO of ZANA Investments, Tim Little. We help people diversify away from the volatility of the stock market and get competitive returns by providing them the opportunity to passively invest in multifamily real estate. As some general housekeeping rules, please keep yourselves muted when not speaking. If at any point you do have a question, please just drop it in the chat and we'll address it during the Q&A portion. During the Q&A, you can also raise your hand and I'll call on you. And just so everyone knows, this will be recorded and I'll send it out as soon as it's available. Finally, I encourage everyone to put their contact information in the chat so that you can continue to build your network. Okay, with that out of the way, I'm excited to get into the presentation. Tonight, we have the tag team of Dakota Brown and Alex Zapata, both from Franklin Street. Dakota is a senior associate with Franklin Street, where he works in debt and equity for commercial real estate acquisitions, refinances, and developments. Alex is a senior financial analyst responsible for underwriting debt and equity transactions across all asset classes, analyzing financial statements, creating waterfall models, and pro forma cash flow statements. Gentlemen, I feel like the timing couldn't be better to have you on the show and get an insider's perspective on what exactly is going on with debt and equity right now. It seems like so many lenders are reducing the percentage they're willing to lend and increasing the requirements. And of course, commercial rates continue to climb despite them starting to level out or even go down on the residential side. And fresh off another rate hike from the Fed today. So please briefly introduce yourselves and let us know what is going on.
Yeah, Tim, first of all, appreciate you having us on here. I think you're absolutely right. This is a really crucial time that not a lot of people have experienced in their investment careers. It's been about 11, 12 years since we've had a similar style economic volatility time period. So this is quite new for everyone. And I think the timing is great here. Alex and I live in this environment on a daily basis, and we're quite excited to get into the meat and bones of what's going on here. But with that being said, as you mentioned, I'm a senior associate moving into a director role at Franklin Street. I've been there for about 2 years now. I have a background in private equity, worked for Jeff Vinnick for a couple of years, and now switched over to the broker dealer side of the business and work very closely with Alex, who is an analyst on our team, and I'll let him introduce himself as well.
Appreciate it, Dakota. And yeah, Tim, thank you for the introduction and the opportunity to be here. Tim said, I am a senior financial analyst at Franklin Street on Franklin Street's capital markets team. Like we talked about, I'm responsible for supporting all the originators like Dakota across all of our different offices throughout the Southeast, and we have a national focus. So a lot of my time is spent underwriting and researching different asset classes, from multifamily in Tampa to office in Fargo, North Dakota, to self-storage in Clayton, California, really just understanding our deals and making sure that the acquisitions that our potential clients are making are financeable and make sense.
Awesome. Thanks, Alex. And I'm going to share my screen here just so we can bring up our presentation that we've put together. Okay, so we'll start to get into the meat and bones here of, I think the title is very applicable. Rapidly changing debt and equity markets. There's a ton of volatility in the market right now on both the debt and equity side, on the investment side as well. And we'll discuss a little bit more about that here.
Yeah, like we mentioned, there was even a rate hike today. So we're going to cover a bunch of different topics. We'll do some macro with a little bit of micro, getting into the nitty gritty. We're going to, like we talked about, we give a quick background about ourselves, the type of lenders and equity providers that we work with, what people are probably really here for, which is the current market update, where rates are, what impacts rates, where inflation and how it affects commercial real estate financing, and just some of the current trends that we're looking at for the first half of next year, right? And where are we headed, and how can people continue to acquire deals and build wealth outside of traditional stock markets, bonds, those things, right? We're also going to touch on some of the concerns, right? Because not everything is looking super rosy right now, and we have to acknowledge where some of the shortfalls are. And we'll get into some of the underwriting tips to mitigate those risks and how to navigate underwriting and financing in today's environment. We'll wrap it up with a short Q&A session, and we'll go from there.
Thanks, Alex. Okay, so brief summary on who we are. We just gave you backgrounds on ourselves, but To provide a little more context around the company that we work for, Franklin Street, we're a full service commercial real estate firm nationally. We're based out of Tampa. That's where our headquarters is. We have several lines of business: debt and equity origination. That's where Alex and I live, eat, and breathe. Investment sales. So selling multifamily, retail, all the major food groups, all the different asset types. We have tenant and landlord representation. We have a huge insurance team. We have a property and project management team, and we all work very closely together. We were founded in 2006. To date, in 2021, our total transaction volume was just shy of $1.5 billion. And as I mentioned, we're headquartered in Tampa.
Yeah, it's a great overview, Dakota. Now let's talk about some of the lenders that we work with and the equity providers that we work with. We are not direct lenders. Just want to put that out there. We are a commercial brokerage firm arranging debt and equity transactions for our clients, right? And on the debt side, we work with anyone from small community banks and credit unions all the way up to the Banks of Americas and Wells Fargo's of the world. Work with agency lenders, Fannie, Freddie, affordable housing HUD type lenders, bridge lenders that are both DSCR driven and non-DSCR driven, which we'll get into some of those specifics. Private debt funds, hard money lenders, commercial mortgage-backed securities or CMBS lenders. On the equity side, we have a diverse pool of investors, included private equity funds, family offices, high net worth individuals, and even we started to dabble in EB5 investors. Some of the typical deals we work on, Dakota and I typically are seeing deals in that $1 to $15 million space. We're asset class agnostic. We have experience underwriting not only multifamily, single tenant and multi-tenant, retail, industrial assets, self-storage, even cannabis dispensaries, which is a very hot topic recently. And we're, again, location agnostic. Our focus is the Southeast and the Sun Belt states, which is typically where most of the investment is coming from. But like I mentioned earlier, we've underwritten an office deal in Fargo, North Dakota. We've underwritten deals in Clayton, California, and then we've also underwritten deals in Manhattan. So we know a lot of people. We're here to make sure that we're providing the best financing terms that are available for you and make sure you guys can deliver your returns to your investor.
Great. Thanks, Alex. All right. So this is getting a little more into most likely what everyone's here for, current market update. So we're going to touch on a few things here. And the first thing that I'm going to touch on are rates. And starting from the floor up, when we're quoted a rate from a bank or a debt fund or whoever it is, rates are composed of two different metrics. It's going to be an index and a. So we're in most cases on the permanent financing side, we're using the 5 or 10-year treasury. And then on the bridge loan side, we're using SOFR, which could be fixed or a spread that's fixed or floating over SOFR. So an example right now, the 5-year treasury is 3.75. I think it's actually lower than that today. It might be 3.6 something, but each bank is going to use a spread of about 170 to 230 basis points over that index. So currently, if the 5-year treasury is around 3.75%, and banks are using 170 to 230 basis points over that spread, we're seeing rates in the mid fives to around 6%. And we've added a very worthwhile website here to keep in tune with market rates, and that's Chatham Financial. We use that on a daily basis. They have a lot of great other tools and market trends on their website as well. So banks currently are increasing their spreads. A lot of this has to do with uncertainty. A year ago, we were seeing anywhere from 150 to 200 basis points over the treasury. Now we're seeing closer to 200 basis points over the treasury. And the banks are really doing this to hedge their risk moving into the new year. No one's really sure of where rates are going to be. And banks they don't like taking on risky investments. So they're going to do everything they can to make sure that they're not losing money. Right now, current permanent financing terms that we've been closing deals at are between 5 and 10-year terms. We're seeing leverage anywhere from 55 to 65%. A couple of years ago, we were able to get up to 70, 75%. We haven't really been seeing those type of deals lately, just with how compressed cap rates are. So most deals are being financed in that 55 to 65% point. As I just mentioned, current rates are in the low to high fives, with treasuries just taking a dip recently. Treasuries were about 60 basis points higher in the preceding weeks, where we were seeing rates closer to 6.5. Amortization, depending on the asset type, we shouldn't have an issue getting to 30 years on multifamily, industrial, newer built retail, in some cases 25 years, and very rarely we'll have to dip down to 20 years. So the biggest limitation on limiting proceeds is the debt service coverage ratio, or your DSCR, which is equal to your NOI over your annual debt service. So most banks are typically requiring anywhere from really 1.2 to 1.25 times your DSCR. So that's the biggest impact on leverage right now. So at the current cap rates that properties are being purchased at, NOIs in comparison have been lower percentage of that purchase price. So that's really squeezing leverage on a lot of these opportunities. And with that, Alex, I'm going to pass it back to you.
Great. Thanks, Dakota. And like you said, the biggest constraint right now is debt service coverage ratio. As rates move, you have a larger monthly debt service, and it's impacting leverage. We have to be honest with ourselves. And the days of 3% money and 75% loan to value are far behind us. But what really impacts these rates, right? So the federal funds rate, otherwise known as the Fed funds rate, it's currently the main tool that the Fed is using to battle inflation. To give you a perspective, I believe this was our 6th or 7th rate hike this year. And the Fed funds rate went from a quarter of a 0.25% all the way up to what is 4.5% after today's rate hike. And that causes changes in treasuries, right? Like Dakota said, your rate is the 5-year treasury rate or the 7-year treasury rate or the 10-year treasury rate plus spread. Spreads haven't really changed too much. They've widened a little bit, but it's really the change in treasury yields that has really affected why rates have gone from 3.5 to 4 up to now 5.5 to 6, right? And what does that really mean? Treasury notes are supply and demand driven, right? When investors are pessimistic about the economic outlook, treasury yields increase because they have to make those fixed rate bonds more attractive to investors. Because if the Fed is printing trillions of dollars a year and there's no one to take on those bonds from them at a 1% return or a 2% return, then maybe they try to entice them with a 3, 4, 5% return. And it's a fixed rate product that provides risk-free investing, but at 2 or 3%, it's hard to get some people to invest in that when you can go buy a multifamily deal that gives you an 8% return year over year or something like that. And then just, again, general supply and demand of money. People who have, and I think the residential market is a good case study for this, people who have low interest rate mortgages are not really interested in selling or refinancing right now. So that outstanding paper on the balance sheet is just out there. There's not payoffs coming in and new money being put out because that's generally slowed down with transaction volume slowing down. And when there's dry powder or hundreds of millions of dollars sitting in banks, they've got to do something with it. And it's definitely impacted rates and made them even more risk adverse than they already were.
Yeah.
Awesome.
And guys, I'll just say I'm a perfect example of that. I refinanced my house at 2.65. And I think I can confidently say that it's not going to get any better than that. So you're right. The incentive to sell at that point is virtually gone. And
Yeah.
even if we do move, I would much rather just rent it out. One, because I know the rental rates here in South Tampa, but two, because it's such cheap debt that what I'd be incurring by getting a new mortgage and everything else,
100%.
it just doesn't make sense.
Yeah, 100%.
Yeah. Yeah. And Tim, that's such a good point. A lot of people are looking at how competitive the market's been as far as people wanting to buy. The supply is not being as much as the demand, which really pushed down cap rates. This is an issue behind the scenes that not a lot of people see that aren't living and breathing the debt and equity markets on a daily basis. This recycling of cash, and banks are in the business to lend. And if they don't have enough money to lend, that means their supply is shrinking. And if anything, I understand investors, the demand to buy these properties may be slowing down, but that demand is not necessarily going to be going anywhere. So this is going to be really important moving into the new year, making sure that if you're constructing a property or acquiring a property, the bank that you've worked with for 10, 15, 20 years, they may not be able to lend anymore. And there may not be any local banks. And it's important to be in tune with who's staying active and how much cash is on their balance sheet.
Yeah, can I go back to something that you talked about earlier, which was you were saying that you could get fixed or floating for bridge. I think that's a really important piece to talk about because so often multifamily operators are using bridge loans in order to acquire. It's becoming less attractive now, I would say, and you guys can probably talk a little bit more about that. But I'm curious as to rate caps, if you guys are privy to what that looks like from your side in terms of the cost of those rate caps Because I remember back in, I think it was 2021 or 2020, we got a rate cap, and it was only because the bank required it. We're like, whatever. It was like 150,000, and this was for a relatively large property. And nowadays, that same rate cap would cost $800,000, and that's exactly what we're paying on some of our more recent deals. You could talk about that a little bit, as much as you're comfortable talking about it, and the impact that's having on investors as well, and how that may just kill deals.
Yeah, really good question there, Tim. And I'm heavily advising all of my clients right now to, if they are taking a bridge loan, take out a fixed rate bridge loan. The delta between a floating rate and a fixed rate bridge loan right now isn't extremely large. It's well worth it to pay a little bit more for a fixed rate bridge loan right now than it is to take on a floating rate bridge loan. And as far as the rate cap goes, it's almost next to impossible to put a price on those in today's environment with how volatile everything is. Those are changing literally on a daily, if not more than a daily basis. With that being said, we're working on a specific opportunity right now. This is 110 units in Daytona Beach. An investor is looking to refinance out of his loan. And unfortunately, refinancing out of a floating rate bridge loan, couldn't hit the senior permanent loan proceeds to fully refinance. So he had no other option but to either sell or purchase a rate cap. And on a $14 million loan, he bought an 18-month rate cap. I believe it was bringing down his index 50 basis points, or putting a cap around 50 basis points over his current index. I forget exactly what the specifics are, but on a $14 million loan, it was about $850,000 to purchase that rate cap.
Yeah, I think we're seeing it too. Obviously, we recently priced one on a 33 million bridge loan out in South Atlanta, and it ended up being the rate cap cost at right now is close to $1 million. That's additional cost that you have to underwrite to, and that's going to heavily affect your bottom line and your ultimate net levered cash flow. And even people who bought rate caps 2 years ago with a 2-year term, and maybe they need to trigger their extension or something like that because of supply chain issues, and they really haven't fleshed out their business plan, they're having to reprice those rate caps. And now those rate caps have doubled, tripled, 5x in cost. It's definitely something that, like Dakota said, we do recommend a bridge loan if it's a heavier premium up front. Even more so than that, I think we're trying to get our clients to move into the mini perm space with a bank if that's a viable option. I know Dakota has done 2 or 3 deals that probably last year would have gone high leverage bridge, and ended up going low leverage bank with a couple years interest only to facilitate that business plan because it just made more sense.
Yeah. And the last thing I'll say on that, just to educate the audience in case they're not familiar, what we're talking about when we say a rate cap is that if you have that floating rate bridge loan, it basically protects you. Think of it like an insurance policy. If your floating rate is, say, two points, if it goes over whatever that cap is, then it kicks in, like I said, like insurance, and pays out whatever that difference is. And gentlemen, please add more context to that. But that's basically my understanding. And I think it's worth explaining to people because honestly, 3 years ago, I didn't know what a rate cap was because it's just not something that was talked about because rates only went in one direction, and that was down. I think it's something you have to know now.
Yeah, and you're spot on there, Tim. Rate cap is putting a cap on the index. And depending on what kind of cap, if you want to put a cap on where it is today, or if you want to cap it off at a certain loan amount, the pricing on that is going to change drastically. And you could even buy down the index slightly, which is surprising. So it's technically buying down your rate, but you're sure going to be paying for it.
Yeah. I think one thing that's very valuable to our clients that I think most people need to be in tune with is on these shorter term bridge loans, that index is SOFR, right? It's the 1 month term SOFR, which you can find on Chatham Financial that Dakota mentioned earlier. And if you look at the projected curve over the next 3 years, you're probably looking at that index, which is currently 4.25 almost. It was probably closer to 0 12, 18 months ago, and it's probably going to approach 5 at some point. So when you use that index plus a spread, call it 250 over term SOFR, today you're looking at 6.8%, as opposed to 12, 18 months ago, you're looking at barely 3% for your floating rate deal. And as you're transitioning a property and cash flows are affected, it'll definitely affect that bottom line.
Yep. Yep. Thanks, Alex. Okay, so briefly getting into inflation and the labor markets, I'm kind of aware that inflation is on the run. It's been on the run. And another thing I want to touch on is the labor markets as well. But the annual inflation rate decelerated to 7.1% in November of this year compared to 9.1%, which was the highest since 1981. And that 9.1% was in June of 2022. So it's good to see that inflation just started coming down, and these numbers are run from the Consumer Price Index, the Bureau of Labor Statistics. You can look this up online. We can start to see that the Fed's rate hikes have been slowly taming inflation. And the biggest goal that we're going for right now is to have a soft landing. The Fed caught inflation quite late, and they're battling it very aggressive. And the last thing that we want to do is freeze up the economy and put ourselves into a recession, which is not the plan, obviously. So the Fed is playing a fine-tuned game of how much do we have to raise interest rates to level inflation to our standard, which is between 2 and 4%. And then labor markets. So we're starting to see inflation come down just a little bit, which is great, but we're also going to need to see labor markets ease up a little bit as well. I believe our current unemployment rate is around that 3.2 to 3.4% currently. And really, we should be seeing between 5 and 6% unemployment on average. So we're going to have to see both inflation and the labor markets continue to cool down before we really see a bigger light at the end of the tunnel.
Yeah, that's great, Dakota. So we're going to dive into some of the kind of current trends that we've been seeing probably over the last 12 months, but really even more so over the last 60, 90 days. Both lenders and LP, co-GP investors have uncertainty in the market. It's a wait and see game. A lot of the larger institutional banks, your Bank of America, your Wells Fargo, if you're not a current client and you're not doing a home run deal, they're probably not providing anyone money. And on the LP side, there's a lot of uncertainty around raising rents and true value add in terms of being able to project a business plan and ultimately hitting the returns that you're promising to these investors. I think on the other hand, the Sun Belt remains probably the king of investment at this point. I think probably the way that Florida and the Sun Belt handled the pandemic really helped them. And people continue to move here every single day. I'm sure Dakota and Tim will tell you, I feel like the traffic has just tripled in the last 3 to 6 months. And I know it's snowbird season here in Tampa as well, but people coming down from New York and LA and less investor friendly states to Florida, Georgia, South Carolina, those types of states that want businesses to relocate from Wall Street to Miami to Tampa. We had a big thing for St. Petersburg was getting ARK Investment to come down here. And Miami's had hundreds of Wall Street companies come down to Miami, and that speaks to the strength of the Sun Belt, right? And I think that investor demand is there, and that's why you haven't really seen a ton of value decline yet, because hundreds of people are moving here every single day. From an asset class perspective, multifamily is probably still king. It's the most sought after asset class. It's the most competitive asset class. I think for us specifically, 50% of our business is multifamily, probably even closer to 60% over the past 2 years, because it was cheap to buy deals, and deals made a lot of sense. And an asset class that's come to the fore since then is industrial, right? You've got Amazon expanding like crazy and everybody doing these online orders, and the days of going to the store and spending 3-4 hours at a retail center at the mall, not gone, but they've significantly reduced. So industry and storage of being able to put all that stuff in one location with access to delivery and major corridors is incredibly valuable. Like I said, retail has recovered well since the pandemic. I think a lot of people are out there buying. I think consumer spending for the holidays is probably just a little bit under where it was 3 years ago, but it is still probably outpacing what people thought based on inflation and kind of the tightening economy. I think there's a heavy scrutiny on good retail. And what does that mean? A good tenancy, people and businesses that have been in your shopping center for a long time and have strong financials. I remember the first retail deal we did post-pandemic, there was a lot of questions about the owners of businesses, how their financials are, how long they've been there. And that's something that wasn't really asked prior to COVID. And I think the people that are struggling are office owners and hotel owners. Office with remote is struggling. I think a lot of people are coming back to the office and they prefer a hybrid environment, but If you're talking about your five days a week, 9 to 5 office day, that's changed. I think for everyone except for Franklin Street. But and then on the flip side, hotels, right? People are traveling. And I think the hotels that are dedicated towards leisure and travel, like St. Pete Beach's hotels, are full of people. And those asset classes are trading for ridiculous numbers. But your kind of more business class, off the highway type of travel and leisure hotels are struggling a little bit. What was once a 7 cap is probably now closer to a 10 cap. Lenders have a very strong aversion to financing office and hospitality altogether. They're more interested in multifamily, industrial, self-storage, retail, those types of things. And that has to do with interest rates rising, right? This will drive up the cost of capital for investors, which causes a couple of things, right? Cap rates have to decompress, which we'll talk about negative leverage in the next point, and leverage will have to come down. Sponsors and buyers are having to bring more equity to the table, which can make a deal not really work for them, right? If the cost of your debt service is more expensive and the amount of money you have to bring to the table is double what it might have been, it might not make the deal pencil. And like I talked about, negative leverage is when the cost of borrowing money. So if you're borrowing at a 6% rate, but the deal you're buying is a 4.5 cap rate, that's negative leverage, right? It is more expensive to pay your debt service than it is to just acquire the property and enjoy the yield that comes off of that property, right? And that's a very popular topic that's come across, and especially the multifamily value add space, where people are paying enormous amounts of money per door for a multifamily property when the going in cap rate is 2, 3, 4%, but you're borrowing at 5, 6, 7%, right? And ultimately, there's still a gap between buyer and seller expectations. Buyers want to buy at today and tomorrow's prices based on 6 and 7% interest rates. And I think sellers still want to sell right along the top of the market, right? They want to maximize their price. And it's hard for buyers to get the type of financing that allows them to maybe potentially overpay for an asset and gamble a little bit more.
Yeah, thank you, Alex. And to reiterate there, that's one of the biggest, that gap between buyer and seller expectations is the biggest factor right now that's kind of slowing down total transactions. We have buyers and sellers pointing fingers at each other, and they're not on the same page right now. And we're expecting that to change coming into the new year. There's been a lot of disruption. There's a lot of uncertainty. But as we progress through this volatile market, we're expecting those buyers and sellers to slowly start getting on the same page. And we think a lot of that's going to have to do with cap rate decompression.
Yeah, and I'll tell you guys, I'm seeing that in real time as we're trying to get deals, going back and forth with these sellers who oftentimes have what I consider anyways as the buyer, unrealistic expectations, because we are not in the same place as we were even 6 months ago. I'm sorry. And yeah, I think a lot of them are just in denial, and I get it. You want to get what you thought you were going to get, but you have to take the current market conditions into consideration. And some of them are. And then there's retrading going on, a dropping of prices, or at least changing things a bit. But I've seen price drops of $1-2 million because debt has gotten so expensive that the seller has to acknowledge that. But nobody likes it, but it's just the reality at this point.
Yeah, Tim, that's a good point. And not only is the debt getting expensive, but we're also seeing post-acquisition insurance and taxes get a lot more expensive. Specifically insurance. Here in Florida, insurance has been an ongoing issue. And with the recent hurricanes, it's only become an even worse issue. So those are all things that are really impacting this gap. Okay, so where are we headed? No one has a crystal ball and no one could really predict exactly where we're going to be, but I think we have a pretty good understanding of where we stand currently and a pretty good understanding of where we're going to be heading into 2023. The best part about ending the year on these rate hikes, I guess you could say, is that we've started to see inflation cool down a little bit. It's came down from June of this year at 9.1% to 7.1% as of November. We had our 7th rate hike today, which was 50 basis points, which I personally think is still pretty aggressive. I believe it's been 22 years since we've aggressively raised rates this much. But that 50 basis points is coming down from the Fed's previous 75 basis point hikes, which economists and the general investment community saw as a positive. Coming into 2023, the Fed's goal is to continue taming inflation. So I think we're going to see 2, 3, maybe 4 25 basis point hikes. If I had to put my finger on it right now, I would say we're going to see 3 25 basis point hikes, and then the Fed's going to hold their rate, the federal rate, steady until we get inflation closer to that 2 to 4%, that 3% mark. There's a lot of investor optimism around the recent CPI report. It came back a little bit better, not much better, but a little bit better than what most economists were expecting. And that goes to show that the Fed's rate hikes are working, and it gives us a little bit of optimism about a soft landing. Obviously, we have a lot more to go through. The Federal Reserve still has a lot of work that needs to be done to hit that soft landing, but this was a good initial sign, a good starting point of saying, hey, this might be working.
Yeah, I think there's a lot of optimism, but there's also still a lot of cause for concern, right? Are we really handling the raising of rates effectively? Are we doing it too quickly? Because inflation and CPI are technically a 6 to 12 month lagging. It lags 6 to 12 months to really feel those effects. So potentially we could be setting ourselves up for a very tough Q1 and Q2 of 2023. But again, we don't have crystal balls. There's a lot of people a lot smarter than us who will probably try to figure this out, and hopefully it doesn't come to that. Underwriting exit values have to be evaluated very closely. The days of buying a deal at a 3 cap and exiting at a 4 or 5 after you've increased value tremendously is heavily scrutinized, right? And lenders and LPs are heavily stress testing the exit cap rate, because a lot of deals are that's where all the money's made, right? Is that exit or that refinance. And those exit stabilized cap rates have widened, right, with regular cap rates. So what we could probably test at a exit 5 cap is now being tested at a 7, right? And that generally affects returns. And then rent growth, right? A lot of these value add deals are bought on the basis that you can come in and renovate and raise rents $200-$300, or maybe the seller's operating the property inefficiently and you can come in day one and just raise rents $150. But at some point, those rental growth rates have to slow down, and I think we're seeing that right now. I think the last report I saw was that rent growth has even gone down. Landlords have had to lower rents for the first time in probably 2 or 3 years, and that ability for buyers to come in and project that they're going to increase rents 5, 10, 50% year over year is being scrutinized by lenders and investors everywhere. And then ultimately, like we've talked about this entire time, it's harder to find competitive loan options to make these deals work. So how do you combat that? Prices have to come down, right? And in general, lenders are very risk adverse. They are a bank. They want to be as risk-free as possible. And there's a lot of uncertainty around where rates are headed in the next 24 months. So we will see the diversity between spreads that we're seeing from banks is really what's eye-opening, right? There are some deals that we're getting a 200 basis point spread, and other deals we're getting a 300 basis point spread from other banks. Same deal, but seeing that big spread in interest rates is definitely causing some concern. And then investors are taking additional time to analyze underwrite deals, where you could probably get an investor to buy into your business plan is taking probably double the time, because they want to make sure that they have every data point that makes them feel like their investment is good. And let's talk about some underwriting tips. Like we've talked about, right? Lenders are not as bullish as GPs and owners due to a strong risk aversion, right? So they're going to be stress testing your deal every single way they can, right? They're going to cut rents. They're going to increase vacancy. They're going to adjust expenses. They're going to go from a 40% expense load to a 45, and kind of see how that affects the debt service coverage ratio and how they can make sure that their investment in the property is going to be able to repay their loan. I think it's really important to understand the story of your deal prior to underwriting, and that's definitely the area that you're buying in. I know Tim and Dakota will tell you South Tampa is very different from Seminole Heights, Lutz. A property in South Tampa for $3,000, nobody really bats an eyelid, but $3,000 up by USF or up in North Tampa, I think that property will probably sit vacant for 1, 2, 3 years, right? You have to understand what is the area median income and who your demographic is, right? So when you're trying to pencil out rent increases and value add opportunities, you have to make sure that you're catering to the right type of tenants that live in your neighborhood. Taking a C class property to a B plus or an A minus is very difficult, but taking a C class property to a B minus or C plus property and increasing rents $150, $200, that's very achievable. But again, you have to understand all those different factors that you might not see from a CoStar report, or you might not see from an investment sales package. They tell you the market rent is $2,500, but all the comparable properties are 20 miles away in a better submarket. So you got to understand and analyze all that stuff. I think, like Dakota mentioned, there's a lot of changes that lenders are going to underwrite to post-closing, right? Your taxes are going to readjust. And what that really means is that you are going to be taxed based on the new value of your property. It will be, in most cases, a significant increase. And we have to look at what the property can support with that adjusted tax number going in day one. Might not adjust in the first year based on when you buy your property, but eventually it will adjust. Insurance, like Dakota said, in Florida is very tough to find an affordable insurance policy that makes sense, right? You have wind coverage, you have properties in flood zones, you have in general liability and umbrella policies that have probably gone $1,000 a unit to $1,800 a unit. And every case is different, right? Newer assets are cheaper to insure than 1970s built assets. But in general, insurance has increased year over year by probably 10, 15, 20% on most cases. And our insurance business allows us to see real time what those premiums are coming in at. And if a buyer has $1,000 a unit in insurance, but all the insurance codes we're seeing are $1,500, $1,700 a unit, that's going to affect it. And then management is another one that's pretty popular too, that gets changed by lenders, right? Even if you're buying a 3, 5, 6 unit deal, lenders are going to underwrite management fees, because if they have to take the property back, they're going to hire a manager and they're going to have to pay somebody else to take care of that problem. It's usually an expense that affects the NOI, and most acquisition people don't really think about that. Now, on larger deals, they usually have management and you're not really changing too much there. How can you change? How can your business plan translate to underwriting? Like I said, you have to understand the tenants that are at your property. For example, if you have a retail center where you think you can rent the property for $25 a square foot, but nobody's leases are expiring for 3 years, your cash flow is not really going to change for 3 years. So is your property, is the debt that you're getting going to cause a problem by the time your business plan has to come to fruition? And I think the biggest takeaway that we tell our clients is to be aggressive, but be realistic, right? We're the ones, Dakota and I, who are a little more conservative, but there's hundreds of data points that can support your underwriting and your comps and your rent projections, right? And if you're confident and we're confident in that, usually lenders and investors will side with us. And then finally, debt is a tool, but it's not your knight in shining armor. Just because you can get 75, 70% loan to value at 10%, you're going to worry about it later, doesn't mean that's probably going to be the best return for your investors. Sometimes, like we've talked about, maybe it makes sense to put in a little more equity and get a fixed 5 or 6%, right? And again, there are multiple scenarios that we specifically try to run through to make sure that you're delivering the best return for your investors, and ultimately you're setting yourself up for success, because we want you to be able to sell or refi your property in 3 years and achieve those returns.
Yeah, that's awesome. And before I open it up to questions, just a few comments that I want to follow up on. At the top there, you say lenders are not as bullish as GPs and owners. And it's just funny to me because in our internal conversations as GPs, we follow the mantra of being conservative, right? And that's for the benefit of our investors so that we're not getting ahead of our skis. And we're showing them, hey, even in a worst case scenario, it still works. But then when we're presenting to lenders, there may be the rosier scenario because you want to show how strong the deal is as well. So I think it's funny that it's not necessarily flipped, but that we as GPs and owners may have to think a little bit differently because the banks are so skittish right now, that maybe we should be showing that more conservative underwriting when we are going to get those loans, because that's what they'll be asking us to do anyways.
I think you're 100% right. If you're showing 20, 25% rent growth, a bank's not going to go for that, right? They're going to go for maybe a 3, 5% rent growth year over year, unless you're investing real money into the property. What our job is to be that balancing act, right? Maybe you come to us with a rosier scenario and we're presenting that scenario. And then we also present maybe a little bit more of a stressed scenario where, like you said, you're being conservative to your investors, And that is maybe the scenario that we show to lenders is, look, this is the business plan and this is the model, and this is supported by comparables. But even if they miss their rent projections by 5%, or if vacancy goes from 0 to 10%, what does that look like? And being able to give the lender confidence that, one, we have confidence in the deal, and two, the deal's already been screened and stress tested, that is incredibly valuable.
Yeah. And then the other thing that I was going to mention is you talk about not expecting those rents to go as aggressively as they have been. And obviously there's a lot of regionality in there, but I think we have to look at the current trends and say, hey, if we are going into a recession, again, assume that is the worst case scenario. We always talk about multifamily being recession resistant, but I think it's important to note that it's not recession proof. It doesn't mean we won't be impacted by a recession. We will, and we need to think about that. We're probably just going to fare a lot better than other asset classes. And then you even have to look at what types of assets that you're invested in. A B class might fare pretty well because they weren't going to go up to an A class anyways, but they don't want to quite move down to that C class asset. But that C class asset is very price sensitive. And so if you start to hike those rents, they may move out and they may just suck it up and go to a D class or move in with their parents or whatever the case may be. So again, while we often tout multifamily as being recession resistant, we have to remember that it's not recession proof and to keep those things under consideration.
Absolutely.
All right, gentlemen, really appreciate this. Unless you have some more, I was going to try to go into some questions before we run out of time. Did you want to cover a few more things, Dakota, before we go there?
No, that's all right. I guess the last thing that I have to say is I'll bring this to a quick conclusion to drag this on any further is rates, they're going to be rising coming into the new year. And there's a ton of uncertainty. There's a lot of volatility. And with that is going to come a lot of opportunity. There's a ton of individuals that just got into this space in the past 24, 36 months that kind of was making money a few years ago, but now things are getting a little tougher. And I believe it's going to present a ton of opportunity. And we're staying very optimistic coming into the new year. Although rates are on the rise, there's going to be a lot of uncertainty. We've seen a little bit of a slowdown in transaction volume, but there's going to be a little more clarity coming into the new year. We can see inflation starting to slow down. And as I just mentioned, with disruption comes a lot of opportunity. But we'll wrap it up right there. And I would love to entertain any questions.
All right. Do we have any questions from anyone in attendance? If not, I can always play greedy host and ask all the questions that I have and get those answered. But I want to give everyone else an opportunity. No? Okay. Let me ask real quick then. So does Franklin Street do bridge to agency debt? That's something that we've been looking at. It's not quite as common, but we've discovered that it's a thing. That way you can, I don't want to say seamlessly transition, but reduce the risk of what comes after that bridge by having that agency debt lined up. And from my understanding of how it works is you go into it knowing that you want to do that structure. And so both are put in place initially. And so I think something like that would significantly reduce the risk and would make investors feel a lot better, especially in an environment like this. So are you familiar with that? And is that something that you guys have seen or actually transactioned in?
Yeah, that's a really good question, Tim. We do quite a bit of bridge to agency. We also do bridge to HUD, bridge to bank style financing, mini perm style financing. But coming back to the bridge to agency product, I do agree with you. It puts in a certain level of return metrics that need to be hit or income thresholds that need to be hit that you know and you're aware of and are black and white. It's not a gray zone that need to be hit in order to take that agency style product. And most of the bridge to agency products that we're originating, the bridge lender on the bridge side, they're getting a little less pricey, knowing that, hey, like they're going to have to hit like very specific income thresholds to get into this agency product. So we get very attractive rates on those bridge to perm products and bridge to agency products. Most recently, we've been seeing fixed rate bridge into agency style financing.
Yeah, to piggyback off that, I agree 100%. We're seeing a lot of that business, and it's something that if your business plan is to potentially hold this asset long term, but you have to do some value add up front, it makes complete sense. It's probably a cheaper cost of capital. And you're doing a lot of that upfront underwriting for the perm program, so that when 24 to 36 months, the refi comes along, the lender's familiar with the operations of the property, and you know where you need to be, and you're able to foreshadow, okay, where your business plan needs to be in 24 to 36 months. And yeah, like Dakota said, we do a ton of that business, and it's a very popular thing. And I think it ends up being very fruitful for the investors who go through that process.
Awesome. Yeah, that's really good information. Another thing that I've seen is there's some properties who have recently done hotel conversions, right? And so it's one thing to do the hotel conversion yourself. I've looked at that, haven't followed through with it, but I've seen a couple of properties where they were like, say, 2020 or 2021 hotel conversions. Are there any unique lending requirements associated for properties like that that have really small units, basically efficiencies?
Yes. The biggest one is, the first question we always get is, do these units have kitchens? Do they have a kitchenette? Because if you're going to go from a hotel to where somebody's going to be living for a year, you got to be able to provide them range, maybe a 2 stovetop or anything like that. And if they don't have it, what does that cost look like? And hotel to multifamily conversion is a very popular concept. I think it's a lot more conceptual than it has been executed in certain markets. I think we've probably looked at 10 of them and only were able to transact on one of them, because the underwriting metrics and the price per square foot or the rent per square foot that these units command is tough to justify, right? Because if you're talking about 350, 400 square foot apartments, there's only so much that a tenant is willing to pay. And I think it's a good alternative to a lot of the high class A stuff that's coming online, even here in Tampa. But it is a product that's been done, and there's a lot of intrigue to see that after the properties have been converted, usually with bridge debt, how do they appraise? And then ultimately, what does the takeout look like, right? Because that's probably what you're going to be seeing now going into Q1, because you need 2 years to shut the hotel down and convert it.
Yeah. And another thing too, going off of what Alex said, is I wouldn't really consider this a requirement to be run as a multifamily property, but any lender is going to look for some kind of experience doing that before, or some kind of like heavy value add multifamily experience. Sponsorship is going to be really important to get debt lined up on those hotel to multifamily conversions.
Yeah, and that absolutely makes sense. Alex, you have a question?
Yeah, hi. Thank you guys for providing a lot of value tonight. One of the questions I have earlier was mentioned that where the interest rate becomes a lot higher than the cap rate. The problem with that, is it because ultimately you have to bring a lot more money into the table? Or can you elaborate a little bit more on that, please?
Yeah, absolutely. If you think about it this way, right? If you bought your deal with all cash, right, and you were getting a 10% cap rate, right, meaning your property's putting off $1 million in NOI and you bought it for 10 million, right? If you're borrowing at 5-6% versus think of your cap rate as your yield. Basically, if you bought this property all cash, you would make 10% on that investment, right? If your cap rate is closer to 4% and you're borrowing at 6%, the cost of borrowing money exceeds your yield, right? Which your yield is basically your cash on cash return. What is going to be your net? It's going to be an unprofitable investment for you when you get all the way down to your bottom line. So the cost, but typically when you see those deals from a bank perspective, you're probably having to bring 45-50% down, where with a traditional bank loan, you're probably having to bring 25-30% down, right? In the bridge space, when you have those deals where the cap rate and the cost of capital are inverted like that, they want you to probably bring more money to the table to get you to a neutral leverage point or a positive leverage point, where your cost of capital is less expensive than your cap rate. Does that kind of answer your question?
Yes, that does. Thank you so much.
No problem.
And just going off of that too, Alex, thank you for the question. So basically, if you're buying a property at a 4.5 cap, you're making 4.5% of the money that you invested into the property at acquisition if you purchase it all cash. If interest rates are 6%, that means you could technically lend money at 6% to someone who's running a property and you'll be a lot less hands-on. You can make more money investing elsewhere in a T-bill or lending money than purchasing that property, if that clarifies it all.
Okay. So instead of, okay, I see, this is another perspective. So when that's happening, then you rather be the lender than the buyer, than the LP investor. Is that correct?
It would depend on your risk profile, and there's a loaded question, but essentially, yes.
Okay.
If you want to, for example, if I could lend money at 6%, and if I'm buying a multifamily property at a 4.5 cap, I'm going to be putting in a ton of work, a ton of effort. Obviously, that cap rate's hopefully going to increase as I add value, but year one, I'm only making 4.5%. Why would I put in all that work when I could go lend money and sit on the sides at making 6%? There's obviously there's a ton of more, there's a lot more to it than that. Obviously, if you're buying a 4.5 cap and you put in the right amount of value, you could be at a 10 cap in 2 years. You got to balance it out, but that's the view that I have on it.
Right. Okay. Great. Thank you so much. I never even knew to look at this perspective. So thank you for bringing that.
Yeah, of course. Thank you for the question.
All right. Good stuff. Any other questions from the audience? We're creeping up. I think we've already crept up on 8 o'clock. So we're almost at an hour right now. I'll give it a going once, going twice. All right. Hey, gentlemen, I really do appreciate you coming over here. And like Alex said, adding a lot of value to the audience. This, again, all this information is very timely. So I was glad I was able to have you come on and relay your expertise here. I'll certainly have all your contact information in the show notes that I post. I put this on YouTube, and then we'll also be sending it out to the list, all those who registered. So we'll have all your contact information in there. Just want to let the audience know, next month, we will have Dave Foster, a 1031 exchange specialist. So make sure that you look out for that one. If you want to get more information on me, please feel free to reach out. I also host a podcast, The Journey to Multifamily Millions. Gentlemen, is there anything else you want to say before we go ahead and close it out?
No, I think that's it, Tim. Really appreciate you having us, and definitely looking forward to staying in touch.
Absolutely.
Okay. Thanks, guys. Thanks for coming on.
Appreciate it.
Thank you.